So we're working through paper 4, very, very important. Paper 3 is due next Friday. We'll talk about that more next week, see where you are. Paper 4 is it's very straightforward as far as what to do because it's a very clear template. It's not easy. And I'll definitely show you what the easy parts are and what the hard parts are. Let me even just show you. So we're going to talk about liquidity, solvency to make sure this firm is a going concern. We're then going to talk about turnover and margin. Then we're going to bring it all together with ROE. On liquidity, we're going to talk about 3 things. CFO growth is an easy one. You just have to look at the CFO growth of your firm and give an adjective or an adverb to it, whether it's strong or weak, those kind of things. A hard one is the net working capital requirement. We'll talk quite a bit about that today because your accounting classes taught it to you backwards. We got to talk a little bit about free cash flow. This one gets a little tricky, and this is one where it's straightforward with Walmart, which is my example. For some of your firms, it's not straightforward. Some of your firms, it's a mess. I've seen some of your firms, and we'll look at some of them, giving examples. Solvency is pretty straightforward. We'll use times interest earned, not one of my favorite ratios. For some reason, it's one of the Motorin's favorite ratios. He uses it all the time. Maybe it's because I come from finance side, which that ratio doesn't make any sense from a financial standpoint. Debt to EBITDA versus debt to equity. Debt to EBITDA is a better one. That one's straightforward, fairly straightforward. There are a few tricks we got to talk about. In this class, I can always tell the students that are on social media, because I'll say very specific things. Make sure if you see this, do this, and then they don't do that in their paper. So if you want to give yourself away for social media, then don't pay attention to those things, and I'll see it. I'll just email you at 2 a.m. Why weren't you paying attention? Because it's some of them pretty obvious what you don't do with that graph, and some of y'all will have that issue. So then we'll get into turnover. Turnover is fairly straightforward on the first one. The second one in red is a little more difficult. We'll talk in detail about that. I just had a class do this, and about half of them got it completely wrong, even though I went over and over again. He's got to really focus and concentrate. Asset turnover is an easy one. Then margins, very easy one. Then we'll get into the summary at the end. You've done ROE decomposition before. We just got to make sure you bring all the pieces together because there's multiple pieces. What you're trying to do is look at the ROE and try to explain why it has the slope or the trend that it has. Is it for good things, for bad things, a combination of good and bad things? These aren't necessarily your scores, but I'll probably use something very similar to this. And then your graphs and your titles. Graphs have got to be in good order. And we'll talk about how you put them in good order. A lot of it has to do with how you copy and paste them into the Word. I strongly recommend you do a bitmap. If you copy and paste a meta file, it's going to mess up your charts. I had one student do it and it flipped everything. Made it so hard for me to grade it because I'm used to going left to right, earliest to latest, and he flipped it. It was going latest to earliest, and I had to completely move it around. But he just copied it from the Excel, but when he pasted it, for some reason, Excel and Word decided to flip everything, change all the colors. It's a mess. So bitmap is the best, but you do have to change your titles. So my recommendation is get the graphs in there so you can write your paper. Then change your titles and put the graphs in there again. It doesn't take but a few seconds to put the graphs in there. So the hardest one are net working capital and talking about the free cash flow, the capacity versus turnover, and then the ROE at the end. Those are the ones that are most difficult to get through. This will be your format. If you look at the Bloomberg, which is what we'll do, I'm sorry, at the Walmart, this is written as a standalone project. You're not going to do this. Right, this is one of the things I'm telling you, and there'll probably be 20% of the class that's going to leave this in here. So there's a good chance to see if anyone's paying. Who's going to leave this in? You're going to leave this in here, right? Everybody? No? Okay. So write it as a through paper. So you don't need a title. You don't need an abstract. This is just the next section. You introduce it. Now I'm going to look at do a financial analysis of my company, looking at. You could use some of this. So if you like this, you can make this the intro. Just don't make it an abstract that's centered like that. Just say, now we're going to do a financial analysis of the company, looking at liquidity, solvency, whatever. So you can use that. You can use the Walmart without plagiarizing. So since you can edit this paper, put it in yours, edit it. Where students make the biggest mistake is they try to keep too much of the Walmart. So if you're doing some tech company, you don't need discussions about the retail industry from Walmart. You take that out. So, all right, so there's a lot of paragraphs you're gonna essentially completely rework because it doesn't apply to your company. But the format is there, the charts are there, the chart numbers. And so if you look at it, we're gonna start off with the simple thing on liquidity. Is their CFO growing or is it shrinking or is it volatile? What did COVID do it to it? Those are the kind of things you're looking at. All right. So let's start with that one. The simplest one of all is kind of a gimme chart. Walmart's cash from operations, chart 1. You can see I changed the title. So you got to come up with the title. It can be tough to come up with a title that fits, but something. So the key is the title of the chart explains why you put the chart into the paper. What is the chart telling you? All right. As much as you can put that in there. So that's the first line. The second line is just what the numbers are. Now, I probably should have put dollars in millions. I didn't do that here. This is in millions. That's 37 billion. So that's an error. So CFO's compound annual growth rate was weak, a weak 2.25%, but it is impressive they've returned to levels from the 2020. You expect 2020 to spike for Walmart because of COVID. You expect them to come back down, but you don't expect them to come back up. So that's extremely impressive that they jump back up like that. It's somewhat sad that they fell that much, but that can make some sense that people are going back to their old habits and making that adjustment. If you're forecasting a company like this, it gets really tough. What are you going to do going forward? You know, that was unusual, but is that unusual? So then you have to kind of ask the question, what's going on with this firm? Why are these lines doing that? That's more when we get the forecast. We'll talk about forecasts as we finish up paper 4, but pretty volatile. The long-term trend was looking pretty sad. COVID brought them back, but this isn't COVID. So there are some things Walmart is doing that's very, very impressive. They're trying to find other revenue sources. They're doing a lot of store pickup and those kind of things. Their website's actually starting to get some volume. So there are some things they're doing. Some of that might be international. There are some things that you can break out on revenue that you can't break out on CFO. You can't break out their CFO for US, Europe, Latin America. You just can't do that. So, all right, that's the first one. You just need a word. So I have students that like their firm's CFO growth was 20.52%. That's what they do. Was a weak 20.52%. Does that sound right? It's 20% growth rate sound like a weak number. So you got to change the number, get out the thesaurus. Or if it is weak, find another word. I use weak, anemic. I hate the word robust, so sometimes I use it just as a joke because right before I retired at USA, everybody was saying robust in every meeting. Just some of my people working for me, they started saying robust just to irritate me. But find some word, you know, Bill Gates will help you with the thesaurus. But find one that doesn't sound like you went through the thesaurus. All right, the second one's a little tougher. On this one, the first thing you can look at is it positive or negative? So what I do is I take your net working capital requirement and I compare it to revenue. I used to compare it to CFO, and it makes more sense to compare it to CFO. But the problem with CFO is it can be negatives. Revenue can't be negative. So what we're trying to do is compare it to something. If you just sell net working capital and it's flying up, it may be flying up because the firm's growing really fast. So if you compare it to something that relates to the firm's growth, then you can sell it. You almost expect it just to be flat because net working capital should essentially grow with revenues because a lot of net working capital is related to revenues. The second, so first, is it positive or negative? Is negative good or bad for liquidity? It's good. That's what we want. That means it's a source. Is higher better or lower better? Lower is better. So how's Walmart doing? Getting a lot better. What happened here? What happened here? They did something strange with a subsidiary there. I can't explain it. I read the paragraph where they explain it. It still doesn't make any sense. Fortunately, I'm not writing a paper right here or right here. I'm writing here. I can somewhat ignore that. And you can ignore bumps in the graph if it's a few years ago and it looks like it was a one-time thing. You can research it if you want to put something in there. You know, you could put a text box in here. All right. So the things you're looking at is, first of all, is it a source or a use? If it's a source, liquidity is probably great for this company. But that's the exception. There aren't many firms that have it as a source. You know, Walmart, Costco, Dell, a few companies. Even AutoZone, we talked about AutoZone is pretty amazing that theirs is negative, but that's because of the way they manage their accounts payable. So start with that. If it's positive, don't go overboard and say this is the worst company in the world, because that's the normal situation. So what I usually say, if it's positive, so is a use of cash, which is the normal situation for most firms, you just stop there and say, so the question is, what is the trend in that use? All right, so just say it's a use, but don't badmouth them and say, oh, this horrible company is totally liquid. That's normal. Most firms have a lot more accounts receivable and inventories than they do accounts payable. So if your firm is a use, just say it's a use, but let's look at the trend and see if it's getting better or worse. All right, questions on that? Pretty straightforward. What about a firm that sometimes it's a use, sometimes it's a source? I think Disney was somewhat like this. There's a few firms where the net working capital requirement just kind of meanders around zero. A firm like that, you can say net working capital is extremely immaterial to this firm. Sometimes it's a slight source, sometimes it's a slight use, but fairly immaterial. They're managing it very, very clearly. So those are the kind of comments you can make depending on what you have. All right. So the second thing you do, so the first thing is it a source or use? A little bit of commentary. The second thing is the trend. So Walmart's is getting a lot better because the line is coming down. You can actually look at the CAGR of the net working capital requirement. And that is on line 31. So we talked a little bit about the CAGR, I think, but the key here is the CAGR good or bad? If it's a source, you want a large growth. If it's a use, you want a small growth. Their CAGR in their net working capital is 14%. That's incredibly strong. That's why they're getting so much better.
For mine has NFF.
All right, so if NFF, ignore the CAGR, and then you just look at the numbers. If it's NFF, it used to be a negative number, now it's a positive number. Or it used to be a positive number, now it's what's your company? I'm gonna try to load y'all's companies, but boy, Excel, Bill Gates can't handle it. And it keeps blowing up on me. And then he makes me enable twice. I don't know why. Is there a reason why he makes us enable it twice? He's like, he wasn't paying attention the first time. All right, so it's NFF. So what are you gonna say is just no CAGR at all. Say Wendy's 10 years ago, net working capital surprisingly was actually a source. Now the amazing thing for them is their working capital assets was a negative number. I don't know how they came up with that. I can't even explain that. But it is now a use. But I look at that and I think these 2 years are probably something unusual going on, especially this year with a negative working capital. I don't know if you actually even look down at the numbers. Yeah, other accounts, current assets was a negative 57. I don't know what that is. Current assets should never be a negative number. So there's something strange. So you can almost ignore 2014. So something that Omar could do is say, in 2014, net working capital looked like a source, but it looked like an unusual year. Therefore, I'm going to look at the growth from 2016. If you do the growth, y'all remember how to do it from 2016? That's in column J. So you just change it. You just change it from dividing by column L. You got to change it in 2 places. Instead of 9, you divide by 7. So since then it was 24%. So you can change your year if you got an NFF. If 1 year is unusual, your starting year is unusual. CAGR only looks at 2 years. If one of those years is unusual, you can get a bizarre CAGR. All right. So Omar could just say, you know, some unusual things are happening in the first 2 years of my analysis, especially on other current assets. I'm going to ignore those because those look unusual. However, net working capital has been growing at an unusually steep pace from 2016. It's up X%. All right. So feel free to use other CAGRs than what's listed there.
It just means that it's not meaningful, is that what?
Well, you can't have a CAGR if the sign changes. You can't grow from -2 to +4. You can't grow from 0, you can't grow negative to positive or positive to negative. So anytime your CAGR is NFF, you just talk the dollars and forget the CAGR. Just talk about what the trend is. It used to be in source, now it's a use, or it used to be used, now it's a source. You just talk that.
Okay.
Or it flips back and forth and ignore it. Don't even use the word CAGR. I have some students that say CAGR is NFF, therefore, don't even do that because that's not going to mean anything to the reader. What does NFF mean? So you just ignore it. Don't talk CAGR. Don't even list the word CAGR. You just talk the dollar amounts in there. If you look at their graph, you can definitely see it went from a source to a use. The nice thing from Omar's standpoint is that it was looking pretty bad to 2020. Probably COVID, right? Although I don't know if did Wendy's do well in COVID? I don't know. But they do home delivery? They probably do some. I don't know. But it's improved quite a bit, and it's been, if you ignore the COVID years, it's been relatively flat. So you might be concerned that they're becoming less liquid, but since 2018, it's been relatively flat. Those are the kind of things you would discuss when you talk about the trend. All right. So number 1, is it a source or use? Number 2, what's the trend? And then number 3, try to explain that trend. And that's what I give you at the bottom of page print 1. I give you that data to be able to look at that. So here's your working capital assets. You can see the biggest one, inventory, is growing at a very subdued pace. And the largest liability is growing at a much faster pace. So you might say, why don't I focus on that 17%? But it's a really small number. All right, so that one doesn't really make sense. So there's 2 things you got to look at. You got to look at the CAGR, but you also have to look at the dollar amount. And here, the 2 largest pieces, the largest asset's only growing 2%, but the largest liability is growing 4%. That's why they're becoming more liquid. Now, how do you explain that? That gets more difficult. That's where you have to really do a deep dive. Are they paying their vendors more slowly? Are they managing their inventories more efficiently? Why is it that they're slowing down their turnover of payables? Could it be a bad reason? Maybe, but from just what we see, that's good. You'd rather turn your inventory faster and pay your vendors more slowly if you can get away with it. That's a wonderful thing. So for Walmart, I go, the largest working capital inventory growing a CAGR of 2.2, and the largest working liability accounts payable growing a CAGR of 4.45. Not all of you are going to be so straightforward. In fact, if you look at Wendy's, that's where we're probably going to see some noise. Accounts receivable is growing really, really fast. Accounts payable is actually falling. But then we're off of 2014, so that's.
You change the tag for the one, for example, I did it for networking capital requirement. I changed it to 2016. Do you have to do that for the other ones too?
Well, you have to decide. So you can hit or miss, what I suggest, when it really makes sense, you can change it, but then put that in the wording. So you say growth rate from 2016. Just put that in parentheses.
But it doesn't matter too much. Well, unless the other numbers are also unusual.
Well, in your case, you might do the working capital from 2016, and then you might do this last part down here. You might do it from 2016.
Oh, okay.
So you're going to focus on, because if you look at your graph, that's really what you're worried about. From here to here, and it's pretty flat. It's up a little bit. I mean, someone might ask for just this piece. That one you can kind of just look at it. We know the problem is this -57. That -57, what is it? I don't know what that is. You could go look up. That's back in 2014. I don't know if you can find their annual report. That could be a capital IQ error. Who knows? I have seen sometimes these databases accidentally, you shouldn't have a negative asset. That doesn't make sense. So you could certainly say that it's gone from a use of 16 million to a use of 71 million. And where is that use coming from? It's, again, look at the largest items. You might say inventory, but that's a really small number. So you kind of look through and see if something's telling you, but their accounts payable and the current liabilities aren't growing at all. And why is that? So I don't know enough about Wendy's. I would have thought Wendy's would have some inventory, but they only have $7 million in inventory. Well, I guess it's good they don't have hamburgers and buns sitting there for months, probably. But you would think they have some stuff sitting there, paper plates, those kind of things. But maybe not $7 million, more than $7 million worth. Wow, look at, wait, did you see Wendy's ratings? Are those accurate? B3? Why is Wendy's so weak? My word, that is pathetic. Did y'all know that? Single B rating for Wendy's. Did y'all think they were that weak of an organization?
They're not. I think they're downtrending.
That's
Because I've had by the Wendy's by my house, no one's there.
yeah, I didn't realize that. I haven't eaten at Wendy's in probably 30 years, but yeah, I mean that's
I never went back.
all right. So who can tell me what the three things are on net working capital? Number one, top of your head, you're going to discuss whether it's a use or a source. Number two, you're going to talk about the trend. Number three, you're going to try to explain the trend. You're looking at those working capital assets and liabilities. All right, those are the three things that you do. That's what I'm looking for. Walmart is probably not going to help you, huh? Yeah, is it a source or a use? Then you're going to talk about the trend long term over time. And then you're going to try to explain the trend by looking at those specific working capital assets and liability. Seeing there's something that sticks out that explains that something unusual going on. Some of y'all will probably have to say the bump is due to COVID or something. Most of y'all have some COVID impact. I mean, even Microsoft, right? They love COVID. It really helped people at home doing Microsoft stuff they weren't doing before. So you see bumps either up or down all over the place. All right, this next chart I got to explain, make sure everybody's really comfortable with this chart. It's an unusual chart. So we're back to this concept of free cash flow. If a firm is producing free cash flow, they're going to do several things. They're going to pay dividends. They're going to buy back their stock. They're going to pay down debt. They're going to do CapEx. The fifth thing is they may hold cash on their balance sheet, but we're going to ignore that fifth one. So the way I did this chart was thinking that outflows are evidence of free cash flow. So I put the outflows above the line. Above the line are actually cash outflows. Below the line are cash inflows. Now, you might say, well, that's confusing. Wouldn't the cash outflow make them less liquid? But what we're asking here is, are they producing liquidity so they have the ability to pay the cash outflows? So think in terms of cash outflow, this word right here, management's confidence to distribute cash. We're talking about confidence. Who has inside information? Management. Is Walmart going to send 10 billion, $15 billion out the door if they got a liquidity problem? Probably not. That's a lot of money, $15 billion. That's a lot of money. There's a lot of firms aren't worth $15 billion. And Walmart just threw it out the door to the stockholders. And all at once, the year before is almost 20 billion. Year before that, 23 billion or 22 billion. They've sent a lot of cash out the door. That's a firm that's producing cash flow, or they would not be doing that. Now, if you see something like this, those are normally one or two things. An acquisition. Most firms with acquisitions, you see it in debt. Or some firms like McDonald's and Starbucks, right? Starbucks. Miranda, you're in Starbucks? Who's in Starbucks? But Starbucks borrowing money to buy their stock back. That is not a sign of free cash flow. Buying your stock back is good. Borrowing money to buy your stock back, you don't have free cash flow. Free cash flow is just buying the stock back, right? So what is Walmart doing here? This is when they bought Flipkart. So they borrowed money to buy Flipkart. The nice thing about this that you somewhat see is they paid some of that debt back. They did borrow a little bit here and here, but they did pay a big chunk of that back in those years. So the long-term trend is, this is a firm that looks like they're producing a lot of free cash flow. Because they're sending a lot of it out the door. All right. But not all firms do that. So let's look at, I'll just bring up, I don't know about these firms, so we'll see. Every once in a while, eventually this thing's gonna blow up on me because I'm trying to bring too many files in. And again, oh, this is the macros one. Sorry, it's two different questions. So this is Price Smart, which is who's Price Smart? Just saw Price Smart just a minute. Oh, Caspian, okay. See, he's not even here to hear. Right. Do you see any trend there? Here, they issued stock to pay back debt. Here, they borrowed to buy back stock. Here, they borrowed and bought and issued stock. Here, they issued stock and pay down debt. Here, they borrowed money and bought their stock back. That's, you're like, what in the world? Do you see free cash flow there? No, I don't see any free cash flow there. So that's why you can't just look at the top. You got to look at where it's coming from. So, yeah.
Like, would it be like balanced all the, like with this representation, would
Well,
it be like balanced all the way across?
This is one I'd be tempted. You can't even see the dates here. This is one I'd be tempted to go to that 2020 financial statement and try to figure out what in the world were they doing? What were they thinking?
What would a lot of free cash flow look like?
Huh?
What would a lot of free cash flow look like?
Well, free cash flow is all the bars are above the line and they're growing. If you have free cash flows, you're not borrowing money. If you have free cash flow, you don't need to borrow money. You're producing your own cash. You don't need to issue stock. Dividends will always be positive, right? You don't have negative dividends. But so you're looking for a firm that's above the line and it's increasing.
And we would see like very small little tick marks on the below zero. Like
Every once in a while, I mean, there are some firms. You get a firm like a Campbell Soup or something that's just no. It's a maybe I don't know if you can say it's a declining firm, but a mature firm, not growing a lot of really fast, so producing a lot of cash flows. It's just they're just going to send it back. You've heard of high dividend paying stocks. Those kind of firms, you'll see the blue line just going up and up and up. They're not growing really fast, but producing a lot of cash. You remember what the Boston Consulting Group called those companies? Or the cash cow. This produces cash. That's great, but they're not growing really fast. I mean, the best thing you can get is free cash flow that's growing fast. There's aren't too many firms doing that. Microsoft might be a little bit of that. Apple, Microsoft might. I don't have Microsoft loaded here, but they're very impressive there. But yeah, you can definitely. Since Caspian's not here, I'll write it for him, and then y'all have to tell him. But definitely here, you have to wonder what is this firm's strategy. No clear evidence of free cash flow, but boy, you really question about the strategy of this firm. Why in the world are they doing that? Now, some firms, I probably should shut some of these down. Someone doing Costco in here? Or Casey's, that's right, Casey, yeah. I don't want to look at Casey's credit rating. So here's Costco. Well, you notice at Costco, these massive, sometimes they classify them as dividends. Sometimes I'm not really sure what Cap IQ is doing. This is not well, these are not dividend, these are not stock buybacks. They're actually dividends, but they classify them as that. So when Caspian gets to the valuation, he's probably going to have to take this part of it and spread it out, average it over time. Because if you value the firm here using this, you get a massive valuation. Here you get a small valuation. So firms like that, I was just switching the motor in. He says you might do a 3-year, 5-year average to try to spread these out. Now, does this firm produce free cash flows, do you think?
Yes.
Yeah, I mean, the bars are well above. They have some borrowing, but it's not massive. And they have paid some of that back last few years. But they tend to do this massive one every 3 or 4 years. And then it declines. And then they'll do another massive one. But yeah, that's the firm that's clearly doing so the fact that it can be volatile and jumps around doesn't mean they don't have free cash flow. Sometimes it can be lumpy like that.
So
2021, they did a bunch of dividends. They give a bunch of dividends.
Well, these are dividends too, but I don't know why Cap IQ has, if you go back and look, they do these massive dividends every 3 or 4 years. So yeah, that's this bar should be all blue, and I don't know why it's red. This one's accurate though.
Do you think maybe it'll go down once it goes stock split?
Well, it'll be the same dollar because that's in dollars. So the stock split will just, the dividend per share will be lower per share, but the total dividends in dollars will be the same.
Oh, okay.
All right, so here what you're trying to do is try to figure out if there's evidence of free cash flow. And there may not be evidence of free cash flow. You can make statements like, I really am curious about what their actual strategy is. If you see a really bizarre year, you may go look and see what that is, see what they did that year. You do want to focus more on the more recent trend, but you do look over time, look at those big years. One thing I've discovered in finance that students really mess up in their first job is they show their boss a chart like this. And what's the first thing their boss is going to ask? Wait, what happened there? Right? Isn't that the obvious thing?
Yeah.
And what are you going to say? Oh, I don't know. I didn't look at that. So if you're looking at a chart and there's a bar like that, you better go check it out. You want to at least be able to say, I looked it up and I just can't find anything yet. But yeah, at least say you started, or at least make it up and pretend, oh yeah, I was looking for that, but I just haven't had time before the meeting. I mean, you have to lie, but if there's an obvious glaring thing, and that's true for your paper, there's an obvious huge thing going on. If you don't have time to look it up, you can say, obviously something major happened in 2020. I haven't been able to, more research is needed to determine exactly what was going on that year, but obviously something unusual, at least mention it. Don't let a massive, elephant in the room go by without saying something that needs to be said. All right. Now, the other one is CapEx. I could have put CapEx on this chart, but it gets a little messy. So what we're going to do with CapEx is do it as a separate chart as a percentage of revenue. I think it's interesting listening to the motor end. One of his favorite ratios is not CapEx to revenue, but revenue to CapEx. It's a ratio I should probably start using more. But he's asking, this firm's reinvesting in the firm, how much revenue growth are they getting out of it? So revenue CapEx, here he's doing CapEx to revenue. So it's a good turnover ratio I should add to my mix. It really makes, I haven't looked, Bloomberg probably has it. But what we're asking for here, you might say, wow, Walmart has been doing great, but the cash flows have been coming down here recently. But look here, what are they doing? They're giving less to stockholders, but they're reinvesting in the firm. So here's a huge question that you may or may not be the answer, but what is Walmart doing with that money? What is that CapEx? Is it new stores? Are they investing in new technology? What's going on with the CapEx? I can't answer that question because I haven't researched it, but it's pretty obvious that something's going on here. That can be good news if this CapEx is going to produce higher future growth. You're probably okay with them cutting back what they're giving stockholders and bondholders. If they're growing, they're going to, reinvest and have massive growth in the future. Maybe they're investing overseas. Who knows? They bought jet.com. So supposedly their website's doing better. Websites can be expensive to develop. Maybe they're buying some AI. Who knows what they're doing, but they're doing something that you hope will produce higher revenues in the future, which means these bars would go higher in the future with a temporary setback of doing more CapEx. What do you think this line's going to do going forward? Do you think it's going to do that? Probably not. So at some point, you're going to say they're going to find some level and maybe level off or come back down. But you as a finance major, you see something like that, you're just like, you can't go to sleep until you find out what they're spending that money on. Some managements are really good at reinvestment. Some managers are buying their projects. At USAA, we were buying Fiesta Texas and USAA Towers. Horrible investments. Why? Because we had a CEO retiring and he wanted those as these trophies. So yeah, you want to ask those questions. How are they spending their CapEx? Is it going to be producing future growth for this firm? All right. So find a way to tie these two together. You're really trying to say, can the dip here be explained by the rise here? Can the rise here be explained by the dip here? Right? That's the other thing. They could be paying more to their stockholders because they're not reinvesting as much into the firm. So you'll see the question on free cash flow. You're trying to look at these two charts and try to understand free cash flow. All right. So for liquidity, what do? Number one, I actually want y'all to memorize it. I memorize it not for the next 2 weeks, but for the rest of your life. So 5 years from now, I'll be asking you this when I see you in the hallway. So there's three things on the liquidity. What was the first one?
Cash flow,
Growth and cash from operations. The second thing was what?
network,
You can do three things there. Is it a source of use? What is its trend? And can I explain the details of that trend? And then the third thing is evidence of free cash flow, looking at distributions and CapEx. Everybody got liquidity? You want to see other companies? I'll shut down. Well, let's look at Wendy's real quick, given that they're single B rated. I hope Wendy's makes it to the end of the semester. So do you think Wendy's has free cash flow if they're rated single B? Something happened here. Again, is this Wendy's? Do I have it right?
yeah, that's good.
Yeah, that's bizarre, really bizarre. It's if you go back to their 2015 statement, they're gonna say something in the annual report about that. You don't do something that radical. So you go find it's in the financial statement and look it up. That's pretty radical. They brought a lot of money last year, but they did pay some of it back this year. They've been consistently buying their stock back. But why did they borrow this money? Was there something going on there? At least they borrowed the money, but didn't increase their stock buyback. So that's good. So there's the trend there. What about their CapEx? What are they doing with CapEx? It's been on decline. There's not strong evidence of free cash flow there. But the other thing to look at is on print page 1, on lines 15 and further, you do get some growth rates. So the dividends have been growing pretty solidly. Their stock buybacks, they're so volatile, it really depends on the starting year. Their debt they have been reducing their debt, but that's pretty volatile too. But their overall cash flow to their stockholders and bondholders has been growing at a decent pace of 3.36, but it's all over the place, up and down. Even that year when they borrowed $1 billion, they bought $1.1 billion of their stock back. So they still had a slight positive cash flow to their stockholders. I'm going to get out of Wendy's. On the word. And here, if you look at lines 15, dividends have been pretty flat. Stock repurchases have been growing. You can't look at debt because sometimes they borrow, sometimes they pay it down. So here they borrowed this last year. Over time, it's been pretty flat, but again, it's the starting year that's so important. All right, I'll do one more here. I don't think I have Kroger loaded, so I can't. Oh, yeah, I do. Now, Kroger, we know, has been borrowing a lot of money, and it's probably going to show up in the numbers. So yeah, they borrowed a tremendous amount of money back here. They have been consistently paying it down, so that's good. But here again, y'all seen this trend of people borrowing money to buy their stock back. It's so bizarre. I'm quite confident when I took accounting and before you were born, back in the 80s, I'm pretty sure if I asked my accounting professor, would a firm buy so much of its stock back that its net worth went negative? They say, no, that wouldn't make any sense. And now it's done all the time. And I really think that this is the, one person does it and everybody else says, so it's okay, we can do that. And I think that's what's going on here. One firm did it and then a bunch said, hey, why not? I don't know why they would do that, because it's got to be really irritating to their investors, because it makes it really hard to analyze the stock, analyze the company, but you're seeing firms, I don't know if Kroger's net worth is negative, but definitely back here, it could have been, bought back, what is that, about $4.5, $5 billion or $4.5 billion worth of their stock. Well, even another 2 billion, 2 billion, 2 billion, so 6 billion over 3 years. That's a lot of stock to buy back, and they keep doing it every year. This last year, a lot less. They at least paid some of the debt down. It does look like free cash flow here, though, doesn't it?
Yeah.
So from 2018, there's good evidence of that. Now, are they cutting back on their CapEx?
Could it also be that,
CapEx is pretty stable.
it could also be that they were, borrowing that much money because maybe interest rates were good,
Well, firms will never say that. Stock market hates that.
and then maybe to like boost their earnings per share while also getting it.
Well, we'll talk about it. Well, we won't too much. Yeah. So the only reason you borrow money to add value to the firm is to get the tax shield of interest. And there's an optimal point you should be going to.
But they use that to repurchase shares. Wouldn't that happen then?
Yeah, I mean, in that case, they're much more capitalized. Yeah, their ROE is going to go up, and so is their risk. So the only benefit to the stockholder is the tax shield. The fact that ROE goes up, yeah, they're a riskier firm, so the required return goes up. So that's a wash, except for the tax shield.
Okay.
So the question is, do they do this for the tax shield? Now, the question of did they borrow money because interest rates were low? You might be doing that, but you never say it. GM did that, or no, GE did that. And I remember when they did it, and the entire stock market knew that the CFO did it because she thought interest rates are low. GE stock plummeted. The next day she had to come out and say, no, that's not what we're doing. We're going to pay. But everybody knew that was why she's doing it. And the stock market says, we're not investing in GE stock because you can forecast interest rates. If we want to borrow short-term and buy your stock, we'll do that. You don't leverage our stock for us. So yeah, short-term debt is hated by the markets.
Okay.
Even though people thought that's what she was doing, she came out really fast. I mean, the stock really reacted negatively. All right, so there's liquidity. It's probably the toughest section of all of the sections right there. So I'd start working on that pretty quickly, getting that lined up. Solving these a lot easier. Here's where I'm going to see who's on their phone now, because this first chart, times interest earned, higher is better, because you're looking at how much your earnings are over your interest expense. But several of your firms have more interest income than interest expense. And I'm using net interest, which means your times interest earned is a negative number. All right, so here's where I see people are paying attention. If your times interest earned is negative, don't put the chart in there. Leave it out. If 1 year is negative, go to the graphs and delete that 1 year. All right, times interest earned negative makes no sense. If their earnings are negative, it still makes no sense. So the only time it makes sense, a positive number only makes sense if the numerator or denominator, either one is negative. If they're both negative, I've never seen that before. Again, it makes no sense. All right. So if either number is negative or both are negative, the ratio makes no sense. Now, if you want to see it in the numbers, you can go up to the times interest earned. Line 7 shows you all times interest earned is doing EBITDA over interest expense. So you can see Walmart interest expense is always an expense. And their EBITDA is always positive. So it works for them.
Can I see this one?
See what?
Can I see the chart for Walmart again?
Yeah, so for Walmart, all right, so here's a few rules of thumb. The rules of thumb I've always used. If you're below 2, that's a problem. So 2 or lower, you're getting in the dangerous territory. If you're between 2 and 10, your focus is on the trend. If you're between 2 and 10, but you're going up, that's good. If you're between 2 and 10 and you're coming down, that's bad. If you're above 10, not an issue. You're good. Even if it's trending down, you used to be 16, now you're 12. That's fine. And you're above 10, that's good.
Can you read that between 2 and 10?
2 and 10, you're looking at the trend.
Look at where we're going up or down.
Yeah, so if you used to be 8 and now you're 3, that's bad. You used to be 3, now you're 8, that's good. At 10, it really doesn't matter. Above 10 is fine. You might say, well, they're coming down. They're coming down maybe because earnings is falling, but they're above 10. They're not. Here, we're not looking at profitability. We're looking at their ability to pay back debt. So if you're above 10, you're well above where you need to be.
The median is the industry average.
It's the industry median, actual median. I don't use averages because they're skewed by, so I use the actual 50 percentile. 50% of the firms are above that and 50% are below that. All right. So Walmart's in line with that. You can see COVID had an impact, but Walmart has always been above 10 and now they're well above 10. It's just not an issue. Okay.
Can you also use like, the 10% on the negative?
I didn't hear because it messed up the chart too much.
Yeah, that's what I was looking
Probably,
at.
I think over half my charts, or probably at least half my charts, I take out the 90th and 10 percentile.
Yeah, because for like the one that I have for Kroger, it kind of looks flat because.
Right. Yeah, if it's just too skewed, like here, yeah, here you would definitely, you're almost on this chart, I think 100% of the time you're going to take out those two.
Yeah. That was
So Kroger looks pretty good. They're above 10 and they're,
trending upward.
trending up, but are close to 10 above use. The trend's not as important as the fact they're just above 10. And now they're stronger than the industry. But yeah, I mean, Kroger's is fine. We're really asking pass or fail on this one. If you're below 2, you fail. If you're above 10, you pass. Between that, you're looking at the trend to see if you're getting better or worse. See if I can find a negative number. Probably not Costco, but look. Yeah, Costco is actually kind of off the charts, right? So look at Costco's last number. It's a negative number. So how do you handle that? So this is a good example. So let me show y'all pay attention here. Very, very important. I'm not going to show a negative number on here. So I'm going to go data for building crafts. I'm going to find that chart. Times interest earned, find Costco, and I'm just going to take that number out. I'm going to say Costco's ability to pay its debt is not an issue. It's been well above 10. And in fact, this last year, their interest income exceeded their interest expense. So obviously paying their debt is not a problem. I'm not going to put that negative number on the chart. I have so many students, someone in this class is going to do it because they're on their phone or something right now. Someone's going to say, well, I'm really concerned about Costco's ability to pay its debt because look how far it deteriorated. That makes no sense at all. Why did it deteriorate? It didn't deteriorate. They had more interest income than interest expense. Obviously, it got a lot better. The exact opposite. I've had students with it's all negatives. Oh, this firm's horrible. No, they're great. Their interest expense, they have so many, like Apple is probably a good example. They have so many investments sitting there. They're probably making 3 times more on their investments than they're paying in interest expense. When your debt is a 50 billion and your cash is 300 billion or whatever, you're going to do a lot better. So go in and find those numbers and take them out. Here you can see on the 0.1 percentile, you don't want to show it because that's where you get a lot of negative numbers that really don't make any sense. Those are completely nonsensical. So you just take those out.
With that chart, it's for example, since it's you go back, so for example, on the y-axis, since it's so big, can we leave it that big? Or would you want to,
Well,
would you want us to get smaller?
Your goal with this chart is see, are you worried about them being able to pay their debt? You can leave it extreme because obviously that's not a big issue. It's not an issue for them. Yeah.
Okay.
Now, a firm like Lululemon, none of y'all are doing that, but a firm that has no debt, I mean, it's just on the line. You leave it out. Doesn't make any sense. Don't show the chart. So you don't have to show chart 5. The problem is if you don't show chart 5, guess what you have to do with every chart after that? You have to renumber it. So you have to go in and make chart 6, chart 5, chart 7. So you have to renumber after that. Don't go chart 4, chart 6. Right? Your paper gets really confusing. Then your boss is, all over the place. Like, where did chart 5 go? All right. So then you're going to have to renumber everything else. All right. So you're almost hoping you have a chart like this so you can put it in there so you don't have to renumber everything. So do not show a chart 5 with negative numbers. The second thing I've seen is people do this. 18.19% times interest earned is not 8%. It is 8 times. All right, so don't put a percent. Don't talk about a percent. Another thing on times interest earned, I give you CAGRs all the way down. I don't think a CAGR makes sense on a ratio other than I would never put a CAGR on a ratio into a paper. I can look at it to see if the trend's better, but here they're so strong, it doesn't really matter, they're better. All you can say is they're better now than used to be. Don't use that CAGR. A CAGR of a ratio is just a bizarre thing. CAGRs are of dollar amounts. How's the dollar amount growing, right? So obviously very, very strong. They're at 18. Yeah, they used to be at 21. They're a little lower now, but that's not because their debt's getting more difficult to pay back. Just their earnings fluctuate around. So you're going to see those type of fluctuations. That's not a big deal. So times interest earned can be easy if you were listening to what I just said. If you weren't, you might lose 100% of points on that one. All right, debt to EBITDA. Here's another one that can be a little tricky. I do use net debt. There are some firms that have more cash than debt. And again, it makes that ratio look horrible. How do you handle that? So there's Capital IQ and Bloomberg both do total debt and net debt. Total debt is their debt not subtracting cash. Net debt is their debt subtracting cash. So a firm like Apple that has more cash than debt, this ratio becomes negative again. You just don't show it. I don't think that's a problem for most of y'all. For Walmart, you certainly see when they borrowed money to buy Flipkart and they've come back down. The whole industry has done this. Some of this is probably related to COVID as well. It has risen, but it's come back down. So I'd certainly talk about the fact that, yeah, it jumped, but has since come back down. It looks to be well managed around 1.5. It looks like 1.5 is about what they're managing to. They're keeping it pretty strict there. Some of y'all will have some pretty wild charts. The Coke Kroger is actually the perfect example on this one. So here again, get rid of those extremes. This is a chart I almost always do as without the 10 and the 90. So you see that huge increase in debt. So I would say that was concern. On the positive side, it looks very specific plan to get it back down to like 2. Walmart was 1.5. It looks like they're trying to get back down to 2. My guess is Walmart's more highly rated than Kroger's. Yeah, Walmart is AA rated, Kroger's BBB rated. Their debt to EBITDA is 2 times. Walmart's is 1.5 times, but they are trending down, so that's good for them. A few years ago, Kroger's was one of the most just incredibly levered firms. You have to wonder what were they doing with that debt? What exactly were they doing? Were they buying their stock back or whatever? So BBB is a decent rating, but not as strong as Walmart's. Let's see if we can find another firm. All right, I'll do IMAX because I know nothing about IMAX. Sasha's going to be training me on IMAX. I've never been to an IMAX. Have y'all been to an IMAX?
There's only like one.
Yeah, over in,
There's like 7, I think, in
Um,
town, but have one.
well, the one we had in La Cantera, right? Or is that
Yeah,
IMAX?
it's the only one.
Yeah, I've never been over there.
Yeah.
So here's our times interest earned. Y'all can tell me how they look here. So take out the 90th percentile. Definitely take out the 10 on this one. Oh, that's debt to EBITDA, excuse me. Debt to EBITDA. Boy, that looks like Kroger's again. That is Kroger's again. Why is this Kroger's? What did I do? I guess I didn't hit copy well enough. Control C. Say, wow, man, Amex and Kroger's look exactly the
Oh, you
same.
put chart 5 again? Oh, yeah.
No, I just didn't. All right, so what is Sasha going to do with the negative 1768? She's going to go over to data for graphs. And all those negative numbers. She's just going to take them out. There's not that many of them. Start 1. Yeah, these other numbers are just incredibly low. So yeah, for some reason, I'm not seeing the charts. Yeah, the problem with them is their numbers are so massive. So they were low for 2 years and then they're massive. They're just all over the place. So Sasha, when I see something like that, I'm kind of curious what's driving that. Is there something going on with the interest expense, or does this have something to do with their EBITDA just being so volatile? So on that one, I'll look at interest expense and how stable is that? It's just a really, really small number, right? So when you see a firm like that, they just have a little bit of debt and sometimes it's up or down, you can get these massive fluctuations. I'd be tempted with Sasha not even to put that chart in. This firm has so little debt, their times interest earnings just a massive number. They're well above 10. I'd be tempted to just leave the chart completely out. I mean, is that chart really telling you anything? It's just so massive here, and then it's still massive here. You just can't tell because this was so massive. The industry looks like it's at zero. You know, so it's just a bizarre chart. And even the industry goes negative for some reason. So this may have something to do with her industry because I picked companies that were in that category, and that may just be the fact that this industry is just not heavily into debt. If we look at the debt to EBITDA, which I'm assuming is going to be a really small number, we'll see. Which lines do you want to come out? This is one I almost always take out these lines. Right, so here we have a negative number. So a negative number, I would take it out, but you might want to look and see why is it a negative number? Is it a negative number because debt is negative? And debt is never negative, so their EBITDA must have been negative a year. So yeah, EBITDA is negative. You just don't show that number. So you go into the data for graphs. You just take out that one negative number. So it's jumped up here recently. But again, you got to think, why did it jump up? Did it jump up because debt jumped up, or did it jump up because earnings fell? And it's also, this might be some COVID stuff, right? So you have that kind of noise going on. So yeah, EBITDA just got really small and then it's coming back. So it's essentially dropped 60%. So she would still put that chart in there and say a lot of this volatility reflects what's going on with COVID and the volatility in earnings, not so much the volatility in debt. She could talk about how stable the debt was over that time. And so, COVID's going to create some of those issues for some firms, but you can explain it. You just explain what the numbers are doing. Right, just because the chart's confusing, it's not that difficult to say, hey, this is just fluctuation from earnings from COVID, but their debt has actually been fairly stable over that time. Now, it did jump in 2020, so she'll need to address that. Why did her debt jump so much in 2020? But since 2020, it's been pretty stable. Now, did they borrow money related to COVID? I don't know. That's kind of interesting to see if they borrowed money, to do something with the theaters, maybe decide to refurbish their theaters when no one was sitting in them. Who knows? All right, you can talk about the growth in debt over time if you like. That can be an interesting number. But debt to EBITDA is a good number. We like debt to EBITDA better than debt to equity. I did give you debt to equity. If you like that ratio better, you can use that chart instead. But we don't generally use debt to equity in finance, just in academia. It's just not as informative of a ratio. All right, so I'm going to go back to the class notes. And I'm going to talk about the summary of this section. All right, so you got cash from operations, so liquidity, cash from operations, net working capital, and free cash flow. Then you got solvency, times interest earned, and debt to EBITDA. Now you're going to summarize liquidity and solvency all together. We're going to look at the quality of earnings. We talked about that last class. The last thing we're going to do is say, hey, are there some outside parties that know this firm better than I do who have opinion on solvency and liquidity? And there is. There's credit ratings. So we're gonna bring this whole section together on liquidity and solvency by looking at their credit ratings. And see if it's consistent with our opinion. And I gave you the credit ratings at the bottom of print page 1. PriceSmart does not have a credit rating. If you don't have a credit rating, all you can talk about is the Bloomberg 5 years default. So you will say, now I'll look at the assessment of my firm using another entity. I'd like to use credit ratings, but this firm does not have credit ratings. However, Bloomberg has a ratio called blah, blah, blah. And on that ratio, they look like this. Okay. Or you do both. So for Walmart, my final conclusion, short-term viability is not an issue. They're becoming more liquid. Their debt looks under control and they're AA rated. I can't remember where I put the credit rating definitions out there. They're out there somewhere. I'll have to find them and get them to you. But AA rated, it's pretty easy for, I forget what AAA is, but very strong, and adequate, and then vulnerable, and it kind of goes down. I like S&P better than Moody's because theirs is much more succinct. It's not quite so wordy. So do that. And then I just say this is consistent with, if you don't have a credit rating, just say, I would love to show the credit rating, but they don't have one. Instead, I'm going to show you the Bloomberg probability of default. And here you have to decide what you're going to show. Here I decided to keep the 0.1% in there because I wanted to show that Walmart was better than them. Right? If they were up here, I might put the 0.9% in there to show you, yeah, they're above the median, which is not good, but at least they're not at the 90%. So here, higher is worse because this is your probability of the defaulting. So if you look at a PriceSmart that doesn't have a ratio, doesn't have a credit rating, how do they look? So which box would you take out here? Green one, yeah. How do they look? They look pretty strong. How reliable is this? This is a pretty good assessment. There is a pretty good correlation between this Bloomberg factor and credit ratings. So it's a good substitute if you don't have anything else. So you might say, I wish I had more information on PriceSmart as far as their credit ratings. However, it looks like they're doing pretty well. Now, if you just said this is a horrible firm, very illiquid, way too much debt, then that's exactly what Bloomberg's looking at too. So Bloomberg disagrees with you. You can disagree with Bloomberg. Say, I don't know how they're getting that number. That looks unusual to me. You can disagree with them, but you should at least stop and think, have I missed something? Because they're looking at the exact same thing you're looking at. So it's not like they're looking at, how good looking their management is or something like that. They're looking at times interest earned, debt to equity, they're looking at liquidity, they're looking at all those kind of things. So it's unlikely you're going to have a strong disagreement with this number, but you don't have to agree with it, but be ready to kind of justify why you may think that might be the case. All right. So you're going to talk about the quality of earnings. Quality earnings, here's one paragraph that you can leave verbatim in your paper when you're looking at quality of earnings, because that's just an introductory paragraph explaining what we're doing with this. And then you're trying to figure out, are there any major differences between cash from operations and net income? Is something unusual going on? Especially what we're worried about is things below the line bar that are getting larger and larger and larger. Now you see that with Netflix, because Netflix had all that money they're spending on new production. It wasn't going through net income, it's going through CFO. It's corrected itself now, so it's kind of come back, but that makes you nervous. If net income is really strong, but cash from operations is really weak, it's like, what in the world are they doing? Especially if it's getting worse over time. Because if management's cooking the books, that's usually what happens. Net income looks good and cash from operations looks bad. So you're a little bit worried about it. I don't see anything unusual on Walmart. Most of you, that's what you're going to say. But some of you are going to have, let's look at Wendy's. Oh, I shut Wendy's down. Sorry. Let's look at Kroger's. Kroger's is probably going to be pretty straightforward. What about this big other differences? I would just out of curiosity want to go see what that was. How do you figure it out? You go to their annual report, look through cash from operations, and just find some other line that's suddenly large. Could be a pension funding, it could be a realized gain, realized loss adjustment. I'm just curious, what was that? They've had a couple others here in the past. But yeah, just out of curiosity, what in the world happened here? But you don't have to, you almost do have to if it's in the current year. There you do need to go find out what is that. So let's just try it. I don't, this doesn't always work if I do this class. But Kroger, annual report, what was it, 2023? 2022. Where's their other? Okay, here we go. 2022. You're trying to find the financial statements. I was asking Omar if he'd already heard of Dave Thomas. Y'all know who Dave Thomas is? Anybody who in here knows who Dave Thomas is? Wow. Yeah, Dave Thomas. Huh?
Is he a real estate guy?
No. He is nothing now because he's dead. But he's skeletons now. But what was he? What was he the Wendy's? No one knows. Omar knows, but
Oh, isn't that like Dave Single and everything? Like, isn't he the founder?
he's the founder, right? And whom did he name Wendy's after?
His daughter.
His daughter, what is her name? No, it's not Wendy. So what was his daughter's name? Do you remember? Yeah, it's not, that's her nickname, but I think she got it after he's named the firm. And she doesn't have red hair, at least not now. So yeah, you search through, you're looking for the cash from operations. It's in here somewhere the financials are. And what you're looking for is just something that sticks out. It usually does stick out. It's usually pretty obvious. And once you find it, sorry.
Melinda. Melinda.
Wendy.
Melinda Lou Wendy.
Yeah, he died before y'all were born, so. Oh, and the other thing is, look at the charts that they're showing. See if there's something in there, that chart that you might want to show. Some of them aren't all that interesting, but they can be. Am I doing Kroger's or Wendy's? This is Kroger's, right?
Kroger.
Yeah, I don't know where their financials are. There's too many pages. But you just do it, go down and find it. You can do a search on, sometimes you can do search on balance sheet. If you can spell balance sheet. There's only 33 instances of that. All right, so I found the balance sheet, so I finally got their statement of operations, comprehensive income, cash from operations. Here's 2021, here's 2022, depreciation, goodwill, fixed. There's an item right there, 164 million. Here's an item right here. That's deferred income taxes. Here's something pretty. So this is probably what it is right here. Loss and gain on investments is a pretty popular one. We talked about that in a previous class. Because that goes through net income, but 100% of the sale goes through investments, you got to adjust that out because otherwise it's in two places. So it will generally stick out pretty rarely. So that line looks like the culprit right there. It makes you kind of wonder what is Kroger selling? If this is Kroger's, what is Kroger selling? Why do they have such a big line on realized gains? Are they selling stores? Are they selling brand names? Whatever they're selling. So if it happens in the current year, you're gonna need to go look and see what it is. Here is a prior year. You can somewhat ignore it. Depends on how large you get. Again, if it's a huge number, you're probably gonna have to go look at it so you can at least address it to your boss. All right, so the next part we're gonna do, so any questions on liquidity and solvency? Liquidity is hard, solvency is straightforward. Summarize it up. Is this firm going out of business next 5 years or is it pretty safe? It has a Single A, double A rating, probably no issue at all. If it's triple B, probably okay. If it's single B, like Wendy's, you're going to have to address. Walmart's going to have to find some way to make the liquidity and solvency section sound pretty negative. Because you can have a tough time being positive and then get a single B rating at the end of it. That's a pretty horrible rating. It's just one step away from triple C. All right, from here we go into activity ratios. So we're going to look at three things here. The first one is so easy. And it's just how have the revenues grown? So turnover, activity ratios is all about revenue. It's all about the business growth. So the first thing you want to just say is, have their revenues been growing? Been growing 2%, 5%, and then you have to go find an adjective. That's where I think I use anemic for Walmart, but find an adjective, stronger. So I usually think of inflation around 2% or so. You would think any firm would grow the revenues just with inflation. So if they're not keeping up with inflation, you're like, what they're doing? Walmart's pretty pathetic because their revenues are barely keeping up with inflation, and yet they've added a bunch of stores, or they actually recently haven't, but over the long term they have. How can you add a bunch of stores and your revenue just barely keep up with inflation? You think you could grow with inflation plus the growth in stores. You think you at least do that. So there's ways you can kind of judge if that revenue growth is strong or not. But that really comes into the second part where we'll spend quite a bit of time on this one next class. This is where students lose a lot of points, capacity versus turnover. So I'll give you one example just so you can see where we're going here. So revenue growth is 20%. Stores added 22%. Revenue per store minus 2%. What grade would you give that? How are they growing their revenues? Is it easy or hard? Pretty hard. They got to add a store to add a revenue. One firm, is someone doing meta in here? No meta. Meta is I have to show y'all meta. Meta is the perfect example. I'll try to remember to show y'all meta next. For meta, they use revenue per employee. Their revenue growth is like 22%. That's incredible. Their employee growth is like 22%. To add 10% more in revenue, you got to add 10% more employees. That's not a good business model. I've been talking to the physicians in my graduate class, and they're really interested in turnover. It's like, yeah, if you have to add 10% more patients, you have to add 10% more staff. That's not a good business model. You want to add 10% more revenue. How much more staff do you want? One or zero, right? You love that zero. You just automate the whole thing. That's a good business. That's what we're looking at. It can be stores, it can be property, plant, and equipment, it can be employees. What you're looking for is what is that asset that most drives revenues? For a pharmaceutical, it might be research and development. For some, it might be CapEx. For some, it might be, for Carnival Cruise, it might be how many actual cabins they have and their boats. I mean, their revenue drops 20%, but they just added the largest ship in the entire ocean. You must say, well, you know, of course the revenues went up. They have a whole new ship they're filling up. For airlines, it's available seat miles, and how they handle that is how many seats that they have versus how much revenue they get out of it. You don't want empty seats. You don't want to add 6 new planes and you only fill them up 1/3. So that's what we're looking at. So that's where we're going to go on Thursday to get this section down. All right, questions on anything? You'll see this paper is more straightforward, but each one of you is going to have a different story you got to tell from the numbers. All right, and all right, we'll stop it there. All right, so y'all tell me you're looking at a new firm, you got to assess this firm, you're going to finance analysis. What are the categories you're going to look at? Without looking at your notes, you should know this off your head. What's the first thing you start with? What are you going to do on paper 4? And above that, liquidity is the first thing under what? Well, solvency is the second thing under what? Why are you assessing with liquidity and solvency?
Required revenue for.
Huh? Well, you might have said, your hearing is really bad. So, the source or use is under liquidity. What are you assessing? Liquidity and solvency. You want to know if the firm's going to do what? Go under. Yeah, this is short-term viability. You start with that. Is this firm going to go under or not? So that's what we started with. I'm trying to get it so that when you interview and they ask you, I used to ask this interview question all the time. What's a good company? What's a good stock? 90%, 99% of students I interviewed gave me the worst answers, including students in my class. I was like wanting to kick them under the table. It's like, what is a good company? It's what we're talking about. What is a good company? All right. Has good liquidity, is not over indebted. You know, this is exactly the definition. We're talking about another word for this is company fundamentals. How do you assess a good company? If I ask someone who's been in a business as an analyst for a few years, I ask that question and they pull out their briefcase and they got a stack of paper that big and they can't wait to tell me. This is what we define as a good company. So you start off with a good company is one that is high quality. So here we're looking at the quality of the firm. Is it solvent? Is it liquid? All right. What's the second big category you're looking at? Without looking at your notes. They're solvent, they're going to survive. Where do you go next? Long-term prospects for growth. So in an interview, I mean, you're trying to get so that when people ask you a question, I call it visual intelligence. And you're going to develop it over your career. I developed it at USA. Once I got it, I didn't realize I had it. But someone asks you a question about your expertise and you can see the whole problem just like that. I was like that on balance sheet immunization. I'd hear a problem where there's insurance, life insurance, PNC, bank, pension plan. Once I heard the problem, I could see what assets they had. I could look at their liabilities. You want that visual intelligence. And that's what these templates are doing. Someone talks about a firm, you're immediately started thinking, okay, let's look at solvent. Let's look at these different areas. You all remember the two areas we assess growth prospects? How does management grow the business? What we're going to talk about tonight. Turnover, top line growth. That's growing the business, right? That's their revenue. That's what we call scaling the business. Have y'all heard that term before? You got 1 million customers. Now we want 4 million customers. That's the turnover. What's the second thing we're looking at? We're looking at the top line first. What do you think we look at second? Bottom line, margins. That's profitability. That's where management produces growth. They increase the business or they increase the margins by becoming more efficient, more productive, or a combination of both. And then how do we summarize short-term viability? Credit ratings. Quality of earnings. How do we summarize this? We just look at ATO times margin. And then ultimately, we look at return on equity, which essentially brings all those pieces together. Now, what are the 3 things we're looking at under liquidity? This is when all those answers you given me before. Do you remember the 3 things here?
Acquired revenue.
Acquired revenue. Yeah, that might be related, but I'm not sure I can.
I was net working capital.
Net working capital regarding. And what were the 3 things you want to do there? You want to first ask, is it a use or a source? The second thing you want to ask is about its trend. And the last thing is you can look at that trend and try to do what? Details. Yeah, explain it. It's pretty good. Explain trend. So what else did we look at under, what's the first thing under liquidity? Kind of the simple one. Yeah, CFO growth. That's kind of an easy one. And the last thing we're looking at. Free cash flow. Are they producing free cash flow? If they're producing free cash flow, what are they gonna be doing? Paying dividends, buying back stock, paying down debt, increasing CapEx. Okay. I'm in the retention, sorry. You gotta retain this stuff. It's gotta become second nature. How do you retain? It's comprehension and it's repetition, but it's also quizzing. And then it's repetitive quizzing. So I think I told my risk management class, I want to learn all 210 countries in the world. So I did just that, and it took me like a few weeks to learn all 210 countries. It was amazing to me, just that constant requizzing, asking over and over. And that's been huge benefit for me as I listen to the economists. Every country they mentioned, I know exactly where it is, what surrounds it. That story sticks with me. Retention is great. You want to get the retention on this kind of fundamental analysis. And you go into your first job and they say, analyze this firm. You're like, what do I do? It's like, you're not, what do I do? You just start doing it. And that's where you want to get. You've got to get also that how to do it. So you got to know where to get stuff from Capital IQ and Bloomberg and those kind of things. But you have to have a template. Templates are really helpful because they let you just start working immediately without having to reinvent the wheel every time you do it. That's why Porter's 5 forces. Your employer says, hey, assess this industry. Okay. And you can come back and say, well, you want me to do a Porter's 5 forces? Yeah, do a Porter's 5 forces. That's assess an industry, that visual intelligence. Oh, Porter's 5 forces. Yeah, I'm going to do that. Yeah, I can see this firm's going to have some big issues on the buyer power. So templates are important. You shouldn't memorize them for exams or papers. You should just know them. You'll know the question students ask me that they hate my answer, right? Do I have to memorize this for the exam? Or what do I say? Don't memorize it, just know it. Because this is your profession now. You should just know. You should have a template to do a financial analysis. The good news for you is in all my interviewing, very few students know how to do it. It's pretty sad that finance students don't have a clue where to start on financial analysis. So here's a template that you can use. All right. On solvency, we only did 2 things. You remember what those were? Debt to EBITDA. And the first thing we did sounds like something you wear to a formal. Times interest earned. And if you have a negative number in that chart, what are you going to do? You leave the chart out or delete that negative number. Negative numbers on time make no sense, and negative numbers on debt to EBITDA really don't make much sense either, because that usually means either EBITDA is negative or they have more cash than debt. So don't put a negative tie ratio into your paper. All right. Now I know you're thinking, well, this is an open book. Why do I need to memorize this? You need to memorize it because this is your life. This is your profession. Just know it off the top of your head. Oh, that's how I'm going to do it. All right. So now on turnover, we're going to do turnover. We're going to do a few things here. The first one's an easy one, which is revenue growth. That one's really easy. Then we're going to talk about this capacity versus turnover. And then we're just going to look at asset turnover. So those are the 4 sections here. So this is what we're going to cover tonight, and we'll probably get into margins tonight as well. I know it looks like on the syllabus we're getting behind, but if you look at the syllabus, we have some kind of group times at the end that we'll probably use some of those. And we're also going to have some group meetings at the end when we get back to the very, very last paper. And I'll give you a walk, but I'll probably do the walk October 31st versus later in the semester, just because Halloween people don't show up usually. So we'll see. We'll talk about that as we get closer. So if you're worried about Halloween, I'll give you the walk in, even though we're going to do the group meetings after that. Does that make sense? Anybody? I mean, y'all can all come dressed in costumes if you wanted to, but I always come dressed as Warren Buffett. All right. So let's go to the class notes and let's talk about this. We call them activity ratios, turnover ratios. We're just talking about revenue, top line growth. There's so many different words. A lot of times activity ratios are closely tied to liquidity, because we're talking about how the firm kind of manages the operating cycles. That's that activity going on. So activity ratios, turnover ratios, It's how is the firm employing key assets to generate sales? This is really the key of it. And that word assets should almost be in quotes. Because you hear the word assets, you think balance sheet, but it doesn't have to be something on the balance sheet. It can be your employees. It can be your square feet. It can be number of stores. It can be your regulatory assets. It can be a lot of things. I mean, how many cabins you have in a ship, or how many rooms you have in a hotel, how many seats you have on a plane. So it's the assets. What is it? And you have to think really carefully about your firm. What is the main asset they have that generates sales? So Raymond and I were talking about the consulting business. What drives sales at a consulting business? I would say employees. What do you think we use at USAA? It's our key asset. It's employees. So you notice with service industry, it's usually employees. What do you think Walmart would use? Probably not employees. They got a couple million of them.
Stores.
Yeah, number of stores are square feet. The stores aren't the same size. What might an Exxon use? We oil reserves, proven oil reserves. That's what generates their revenue, isn't it? Finding more oil. What would a pharmaceutical be? How does a pharmaceutical spend money? Research and development costs. Exactly. What about Nike? What do they spend money? And this one's kind of obvious if you took some
Branding.
Branding. Branding, but how do you get the brand? How do you spend money to make your brand known? Advertising. Right? So you look at what generates revenue at Nike, it's advertising. It's protecting that brand. Yeah, exactly. It's brand identification. So you're trying to find that for each company. If you're not sure about your company, revenue per employee is a good one to do. I'd probably use that with NVIDIA. Sometimes it's obvious. Some firms, if their property, plant, and equipment is more than 40 or 50% of their assets, I would do revenue. I would look at property, plant, and equipment as that key. So each one of you will have one. I've given you 4 in the spreadsheet, but there are others that you can bring in that are more interesting. So it kind of depends on your firm. In the insurance world, we did revenue per employee because there really wasn't an obvious one to use otherwise. Some firms, it's multiple. With Disney, you might want to look at your production costs, like Netflix, your production costs, that's key to your revenue, but that's for their streaming business. That may be for their movies, but that's not going to work for their theme parks. That's not going to work for their cruise line. Their cruise line is probably going to be how many cabins they have. Their theme park, I would probably do revenue for PP&E, but you can't get all those different pieces. So you use revenue per employee and it looks horrible because they have all these employees at the theme parks. They look really terrible. So some firms, there really isn't a good one. That's why I'm glad none of you are doing Disney. Disney is a really hard firm to assess because it's really 5 or 6 firms all in one firm. So it gets a little tough. So this is what you got to think about your company. What is the key thing that they do in order to increase their revenue, to increase their sales? See, when you see the word turnover, you have a numerator and denominator. The numerator is going to be related to sales. The denominator is going to be whatever this asset is that you picked. So asset turnover is revenue over assets. But that's a little too generic. That's every asset. Receivables turnover is revenue over receivables. Inventory turnover, you might think that would be revenue to inventory, but we don't like to use revenue to inventory. We prefer to use cost of goods sold to inventory, but it's a similar type of thing. So a turnover ratio is something related to revenue over whatever that key asset is that you're looking at. So USAA is revenue over employees. There's our employee turnover ratio.
So this cost of goods sold to inventory work for like something like Walmart.
I went for Walmart. I would for a Valero. So you think about a Valero, what happens to Valero when oil prices rise and gasoline prices rise? Their revenues rise. But what do your cost of goods sold do? They also rise. So in a place like that where it's very commodity driven, like a steel company, they're buying steel, they're processing and selling it. That's when cost of goods sold works really well. Because otherwise revenue shoots up and like, wow, they're doing great. Their cost of goods sold shoots up. Walmart, their revenue doesn't really fluctuate that much. commodities up 40%, a steel company is going to see the revenue shoot up 40%. Gas prices go up 40%. Walmart's probably not going to see that. You probably get a very similar answer, but it's much easier just to get the revenue line off. So commodity driven companies, cost of goods sold makes a lot more sense. But for Walmart, if you're doing inventory turn, you do cost of goods sold to inventory, but for other ratios, you don't want inventory, you don't want cost of goods sold in these other ratios, with the exception of Valero or commodity company. All right, so there's your receivable turnover. You see receivable turnover is closely tied to liquidity. If you improve your receivables turnover, your net working capital ratio comes down, you become more liquid. There's a close tie between turnover ratios related to the net working capital and liquidity. Higher receivables turnovers mean that you're collecting your money faster from your customers, which is always a good thing. Your average collection period, you probably saw that. That's 365 divided by your receivables turnover. That's how many days it takes to collect from your customers. So their lower is better.
For the one before that was higher was better. Correct?
Higher is better on this one, lower is better here. I think I gave you both of these ratios. Let me look in Walmart and see. At the bottom of the capital IQ, I brought a few of them in here. Yeah. I gave you inventory turn and accounts receivable turn. On lines 48 and 49. They're not in the graphs anywhere. You don't have them for the competitors, but you have it for these two companies. So here you want it going higher, not lower. Inventory turn. I don't know if inventory turn, accounts receivable turn. Inventory turn makes a lot of sense for Walmart. Account receivable turn really doesn't.
And then it didn't say on our chart for asset turnover, for example, my case for me is reaching the 90th percentile, better to keep it. To show that it could be a play.
Yeah, you keep the 90. On a lot of these charts, you can keep both, except for you can see here we had a big negative number because of COVID, so I just took that out. But you can keep it in. Right, and then inventory turnover is cost of goods sold over inventory. I might have confused Carlos in your question, but that's the ratio for every industry. So when would you use cost of goods sold for an asset turnover ratio? For usually you sales, it's for those commodity derivatives. For inventory turnover, it's cost of goods sold for all companies. Higher is better. Day sell in inventory, if you're doing a retail company, like a Target, like a Casey's, a day sales in inventory could be an important number. You would hope Kroger's would be a lot faster than Walmart. You hope they don't have apples sitting there for 20 days or something. But so you have to kind of somewhat adjust it for the business that you're in. But again, relates to liquidity. If you improve your inventory turnover, your net working capital requirement comes down, your liquidity goes up. There's a one-to-one relationship. There's a high relationship between liquidity and turnover. There are industry-specific turnover ratios, and you're going to have to try to figure out what those are. So look at your company, try to see what they're reporting on those. That might be in their annual report. Who knows? Make sure to go to your firm's annual report and look at their investor relations and see if there's any PowerPoint that they're giving you to see if there's any ratios in there that they may be following. You may have to create your own, but Capital IQ can certainly, if you got Capital IQ working, or go to the FSC, what you can do, I can't show you here because I don't have Capital IQ set up, but all the formulas are here. So if you wanted to do something in Capital IQ, you could just copy this row down and then go into Capital IQ and look for the ratio you're looking for, and it will automatically populate all of that. But you have to be in Capital IQ for that to happen. All right, so Capital IQ's, you say, wow, I really need that ratio. You can get it really fast in FSC. If you're desperate and I'm on campus, you can email me and say, hey, can you pull that for me real quickly? I don't mind doing that. I can do it from home as well. I'm hoping some of you are getting Capital IQ to work from home. It really is something you want to start getting the habit of using all the time. You got to get used to these formulas and how to pull data. It's a big part of being a finance major is how to get that data in. The service sector, accounts receivable inventory turn may not make much sense. So in those firms are going to find other ratios to use. Might be revenue to employees, revenue to square foot, whatever. We'll look at some of the ratios we have. Consulting firms like Accenture, they're almost always going to use revenue per employee. That's just so key to what they do. So some of the other ones we talked about, your marketing budget, how many rooms you have, how many accounts. So Meta is a good example. None of you are doing Meta, but the key with Meta is how many users they have, how many are on their system. Now you say, well, those users don't produce revenue, but what do the advertisers look at? How many active users are on Facebook? Facebook knows what their active users are. So they distinguish between active users and users. So active users are those that are on there at least once a week, which is like 3% of the people in this room and 90% of your grandparents, right? The whole industry is changing. I see a few of y'all on Facebook, but not very often. I love Facebook because I got all these high school friends that would never talk to me again if they weren't on Facebook. So I get to check in with them. But that's an active user. That's what's going to sell advertisement for Facebook. So revenue per active user, if you look at that number, it's absolutely amazing, the growth in it. You may not have noticed it because you may not be a Facebook person, but Facebook went from very, very little advertising to a lot. You see it in that numbers, and the revenue of advertising revenue per their active user shot up from like $8 to $26 really fast. Now it's kind of leveled off because there's so many other places people can advertise, but that's what you would use. So that for social media, telecom is kind of those, how many customers you have using the service. R&D, hospital beds, available seat miles for airlines, regulatory assets for utilities. A regulatory asset is the asset their regulators allow them to price off of. And that's a key ratio. Revenue to regulatory asset is a key ratio for them. If you have a pipeline company, it's going to be how many miles of pipeline you have. It could be, and this is something that Dan Modern pushes, that I think is really interesting, is revenue to CapEx. It's a really, really interesting ratio. I don't use it. I may start using this one. I have to look and see if Cap IQ actually has it there. You can use property, plant, and equipment if it's a big manufacturing firm. So a firm like Intel, revenue to property, plant, and equipment makes a lot of sense because they're building these multi-billion-dollar fabrication plants. Any of y'all have a company you're not sure what to use? They have to see what you have. So for Casey's, you may not be able to get square feet, but you should be able to get stores. Okay, Carson?
But for like Kroger and Walmart, could it be like gross margin on inventory?
No, that's going to go under margin. Yeah, we're going to look at gross margins. So Kroger's, you're probably going to use revenue per store. Okay, who was it I was talking to yesterday that we fixed your revenue per store? That was Lynn. Okay, Lynn, what company was yours? All right, let me show you something that you may have an issue with. But we fixed it, but I'll unfix it. And I'll probably do the formula wrong again, but that's okay.
Well, they sales and inventory wouldn't fix the Kroger as well.
What?
They sales and inventory.
Yeah, you can use those ratios. I gave them, it's not sales to inventory, it's cost of goods sold to inventory, but it is they call it day sales and inventory, even though you're using cost of goods sold. But yeah, that would be for any retail that has inventory, your inventory turnover, that's what it's called. Inventory turnover is a really good ratio to use.
Okay.
All right, so Lynn came, we did Wingstop, and she got revenue per store, but it didn't give her the number of stores. But obviously, if you have revenue per store, you can get, I mean, if you have revenue store, you can get number of stores. So we added it by just taking revenue divided by number of stores. I'm sorry, we took revenue and divided by revenue per store, and that gave us number of stores. And it gave us a really round number, so it made us feel good that it was doing it correctly. So if you have a zero on, let's say, square feet, they say it gives you revenue per square feet, but it doesn't give you square feet, you can back into that. Just take revenue divided by that ratio. If you have number of employees, but you don't have revenue per employees, you can calculate your own revenue per employee. Okay, so if you have blanks in some of these places and you really want to use that ratio, look and see if you have enough data to calculate it yourself. You don't have to throw in the towel just because it's not there. Sometimes the data is extremely unreliable. So look at Walmart. What do you notice about Walmart's employees? That's not Walmart. Oh, there it is. Yeah, there's Walmart. What do you notice about their employees?
So when we compare the growth in that asset and the growth in revenue, are we looking for like?
Well, we're gonna get into that. We're gonna spend a lot of time on that.
Oh.
Yeah. So anything stick out to you about Walmart's employees?
So how do you do that again? The total number of stores? What is it?
Well, if I don't have number of stores, I just take revenue and divide it by number of stores, and that gives me number of stores.
And if we have the number of stores, but we don't have the CAGR,
Well, we'll talk about that. That probably means you have a zero sum at the beginning.
that's zeros for.
Yeah, so if you have zeros, so Lululemon's a good example. So Capital IQ and Bloomberg did not bring in number of stores. And when you go to Statista, guess what? They fill in those blanks. So I'm not showing it here, but you can find, so we like Lululemon was missing 2 or 3 years. We went to Statista and we were able to fill in those missing years. I don't know why Statista has it and Capital IQ didn't, or Bloomberg doesn't, but sometimes they have a missing number. If you have one missing number, sometimes what I do is I average the year before and year after and just put an average, like on employees. If it looks like it's fairly stable, I just take the average of the 2 years.
So if I'm, let's say on my case, I'm missing all the way to, oh, well, that's 23, but I'm missing all the way to 14.
Yeah, go out and see if someone has, that data is probably out there somewhere. Sometimes if you go to annual report, they'll report that number in the same place in every annual report, and you can just go back.
Going to every single one.
Yeah, see what words are around it and do a search on that in every annual report. So you can usually find it somewhere. Statista is pretty good. I didn't bring up the right one here, but they have it out there. There's one that will show them how many stores they have over time. That will bring that in. All right. So to Omar's question, the key here is how much effort are they putting in to grow their revenues? Okay, so we talked a little bit about last time. So you have a doctor's office, you want to add 10% more patients, but the only way to do that is add 10% more workers. That's not a good business model. That's what we call it's not scalable. What scalable means is you can add more revenue, but you don't have to bulk up on the stuff that produces revenue. So a good doctor's office would be 10% more patients, and they only have to hire maybe 1% more workers, or maybe no new workers. Now, USAA, a great example is we started doing a lifestyle funds. These are these 2050 funds, 2055 funds. We added 0 workers for that, and the revenue growth was 70%. That's a pretty scalable business because it was entirely all online product. So once they got it set up, our workers we didn't have to have any new workers to handle it. They might have gotten questions on the phone, but you have to hire anybody new to do it. That's a very scalable business. You'll notice in some businesses like Accenture, IBM, those that do a lot of consulting, they can't grow their revenues without growing consultants. It's a one-to-one. It's not a good scalable business. So that's what we're after. Can Walmart grow its revenues without adding new stores? And how can they do that? So one thing Walmart's talking about now is AI. I think it's freaky, but you're walking down the aisle, they know who you are, they know what you buy. And so a coupon bounces on your phone for something that's sitting right there above your right eye. Yeah. Pretty freaky, but that's going to increase their sales without having to add new buildings.
Yeah, Target's us actually doing that.
It's kind of freaky, isn't it?
Yeah, you can get like on your phone, you can open up the app and it knows in
You
what
probably have
aisle
to
you're
tell
in.
them you want to do it, right?
And it tells you, oh, the product is like right here while you're looking at the phone.
Yeah. So like HEB is pretty bad at it. I have to go on their website and plug in the number. I'd rather just say HEB, where is the whatever, and it shows me. But they're gonna get better and better and better at this. HEB at some point might notice that I walked by the Campbell soup and it's like, hey, you bought that last three trips, you bought that, are you forgetting it? How can HEB tell me that? Because they know every single food item I bought in the last, I purchased in the last 20 years. They got all this data on me. Do I want them to do that? In some ways I do, some ways I don't. But you know, as long as it's just the computer that knows, unless there are robotics showing up at my house or something, I kind of like that idea. I think it's efficient. But that's a way HEB or Walmart can increase their revenue without having to add a new store. Their existing customers start buying more because they're more intelligent. So that's what we're looking at. So in this part of the paper, you really want to make it clear how much of the growth is coming from added capacity and how much is it coming from improved turnover. Okay. Now the Omar's question, you're not asking which is higher. You're just trying to ask what effort they're doing. So a good example was it Netflix? I think it was Netflix. Let's see if I can find Netflix. Do I have Netflix loaded? I have it in my EMBA class, I think. So Netflix revenue's up 22%. Does that sound strong, weak? That's per year, average. You consider that average, above average, below average? I'm being facetious, so what's the obvious answer? Really strong. But where did it come from? All right, let's look at revenue per employees. Revenue per employee hasn't grown at all, 0.35%. Where's all their growth coming from? To add more revenue or add more people. Now, probably for Netflix, that's, I don't know. You know, I would assume a lot of production is contract workers. I'm not for sure. Now, one thing you know is Netflix, their revenue per employee is exceptional. A typical company's revenue per employee is like 500,000, 600,000, 700,000. They're 2.6 million. Each employee brings in 2.6 million in revenue. That's pretty crazy. That's wonderful. Like Disney is like $200,000 because they have all those theme park workers. But it hasn't improved much. Each worker's not bringing in more. So why are they adding all these extra employees? My guess is they're probably ratcheting up for future revenue. They're doing things now that they can try to get future revenue. So you hope eventually that number is going to kick in eventually. None of you are doing Cisco, the food company, but Cisco, 1 year they hired a bunch of new sales reps. That's going to kill the revenue per employee for that year. But what are you hoping in the future? You're going to generate a lot of new sales. And so it should improve. So what you're looking for is comparing, you want to ask, where is the growth coming from? So most of their growth is coming from adding more capacity. Employees is their capacity. But if this number was like 5 or 6%, you're not, and I think this is your question, Omar, you're not asking, is this one higher than this one? What you're asking is, where is most of the growth coming from? And are they getting good utilization out of their employees? So if it was 15% and 6%, you say, well, most of their growth is coming from adding employees, but they're still getting great efficiency out of their employees. They're getting 6% growth out of that. So don't say it's bad because it's lower. You're gonna have to assess, is that point, we can tell that 0.35% is pretty weak.
Are we looking just at like operating, operations, property plant equipment is higher, but.
Well, property plant equipment is everything. So there's probably some property plant equipment that has nothing to do with revenue, but there's no way to break that out. Does Netflix have employees that have nothing to do with revenue production? Yeah. But you can't break that out. There's just no way. So a consulting firm, they even have employees not related to revenue. And they're probably not very many, but they probably do have some. Does Walmart have stores that aren't related to producing revenue? No, that one works pretty well. Okay. All right, so let me give you a little bit of a rule here. So let's look through this. When we talk about the turnover, sometimes you're going to hear me say, not keeping up with inflation. When would I say that? Right? So let's do revenue to square feet. And let's say that growth rate is 1%. Can you say that's not keeping up with inflation? What if we have revenue to property, plant, and equipment? And let's say that's 1%. Can we say that's not keeping up with inflation? Right? So what's unique about property, plant, and equipment that's not true for square feet? See if y'all can read my mind here. Which of these is on the balance sheet, first of all? Property, plant, and equipment, which means it's in what kind of, how's it expressed?
Asset. Asset.
Yeah, but in what, I'm going to say what currency, but that kind of gives it away. It's in dollars, right? You got dollars of revenue over dollars of property, plant, equipment. Revenue grows with inflation, but what does property, plant, equipment do? It also grows with inflation. So here you don't say it's not keeping up with inflation. Anything above 0 is improvement. Okay. So they'll say, wow, 1%, that's not good. They're not keeping up with inflation. Well, yeah, but everything's growing with inflation. The fact that it's 1% means they're getting better. Well, what about square feet? Does square feet grow with inflation? No. So here you can say not keeping up with inflation. Because you would expect they grow their square feet, the revenue should grow, revenue per square feet should grow at least with inflation. As prices go up, they charge more. So existing square feet should see a growth of 2% just for inflation. Okay. What about revenue to employ? What if that's 0.35% like we saw with Netflix? Can you say that's not keeping up with inflation? Are employees in dollars or are they in units? Units. So there you say not keeping with inflation. All right. So be careful on that. If you're doing dollar to dollar, anything above 0 is improvement. It may not be great, but it's improvement. When you're doing revenue to a non-dollar item, you would expect that number to at least match inflation at the worst, just because prices rise. And when you look at Walmart, it doesn't look very good. Well, actually, it looks good now after, I forget they've had some good years here. I'm thinking 2 years ago. They haven't really added much square feet, but their revenue per square feet has actually been pretty decent, 3%. It's not killing inflation, but it's actually been pretty decent. So their revenues grew about 3.5%. And most of that was improved turnover, even though the bulk of that's probably just keeping up with inflation. Inflation's 2%, so they kept up with inflation and they added an extra 1% of improved. You might talk about it. Let's say the revenue per square feet grew 3%. And inflation is 2%. So they improved 2% just getting inflation plus 1% increase. You can use this term traffic. Does that word make sense? Traffic, more people in the store, or the people in the store buying more stuff? So people spent 3% per square foot, they spent 3% more, but you would expect them to just pay 2% more if they didn't buy any extra stuff, just because prices are going up, which means they either had 1% more people coming to the store, or the people in the store are buying 1% more stuff. All right. So on Walmart, I talk about how they're keeping up with inflation because I'm dividing by square feet. If I'm doing Intel, anything above 0 is good, although Intel is probably a negative number. I'll give you some examples. Revenue is growing at 8%, while the asset to generate that's square feet, is growing at 7%. Yeah, most of that growth themselves is by adding more assets. So that's what you're looking for. And then focus in, don't talk about which one's larger. I mean, it's not bad that revenue per employee is smaller than the growth in employees, but do look at that revenue per employee and assess if that number by itself is a good number. But you can't say most of the growth is coming from increased employees, But then you can say, but their revenue per employee is a fairly decent number, looks pretty strong. Right, so do think about your firm and what do you think is the most important thing they're doing? It might be CapEx. If your firm is heavy into CapEx, that may be where you need to focus your attention. The operating cycle, I think we talked a little bit about that when we were talking about liquidity, but it's how long does inventory stay in the warehouse? How long does it take you to collect from your customers? Minus how long does it take you to pay your vendors? If their net working capital is negative, that's probably gonna be negative days. If your net working capital requirement is a positive number, that's gonna be positive days. So there's a link between those two. I built this into the Excel spreadsheet. It won't apply to most of your firms, but for the retail outlets, it could give you some insights. So how do you improve turnover? You could spend more on marketing, but that might hurt your margins, but it's gonna help your revenue. So you gotta ask, is it worth the spend? You can shut down inefficient assets. General Motors shut down Europe. It just wasn't, Europe wasn't working for them. Their sales are gonna drop, but the assets they had dedicated to that is gonna drop as well. Increase online sales. That's what I was talking about with USAA with that online product. Yeah, people are just coming and buying it. We're having to do anything. It's like free money. That's kind of great. Really nice. McDonald's did this, move from a franchise to moving to franchising from a company-owned store. If you think about this, what happens? What do your revenues do? They drop 85%, right? Because your franchise fee is only 15%. So instead of getting all those revenues, only getting, that sounds terrible, doesn't it? Your revenues just dropped 85%. What do your assets do? You drop almost 100%. Why? Because you don't own the store, you don't own the equipment that franchise does. What is your asset turnover going to do? It's going to zoom up, and that's what McDonald's did. Now, some people argue that that's not true because McDonald's is a real estate company and it's actually owning all these real estate, but that's the turnover of the real estate operation. I'm talking about the turnover of their fast food restaurant. It's a very different kind of thing. Right. So franchising usually, the business breakdown with Cinnabon, Kat Cole, she does such a great job in that, talking about the franchising model and why it's so important to Cinnabon and how it really, really just moves business for them. I mean, Cinnabon, you look at the history, it's pretty interesting. Their first store was doing great, but when they built it, I don't know if it was in an airport, but when they built it, there was no room for the oven. So the only place they could put the oven was out front. But the second store, they had plenty of room so to put the oven in the back. And guess what they discovered? Their sales dropped. Why did their sales drop? Smell. So guess what they did ever since? Have you ever been to an airport? And the Cinnabon is just, I've never eaten one of those things. I think it's like 80,000 calories or something. You want to eat one, though, it smells great. So they discovered by pure random chance that their stoves should be out in front, because that's what creates that smell that goes throughout the entire airport. For all those people with the delayed flights, I do have a philosophy. Delayed flight means you can eat whatever you want to. Calories not going to count, because I'm like so irritated to be in the airport. But they figured out how to produce something that simple. It didn't cost them any more money. They just put the stove out front, but it generated a lot of sales. McDonald's in the 70s, they discovered the biggest hack of all. They started selling breakfast. How many stores did they have to add? 0. I worked for McDonald's for 1 month, Chick-fil-A for a week, McDonald's for a month. I thought it was fascinating. At 11 a.m., they switched from breakfast to lunch. And they switched it. This guy got this big scraper. He scraped all the breakfast, all the grill, and then he put a hamburger down. Took him like 4 seconds. They used the exact same equipment for lunch that they used for breakfast. Not only that, so what does that do to your turnover? You have the same number of stores, but you just added 50% more revenue. Not only that, breakfast has a higher margin than your other meals. That was an incredible kill for McDonald's. Now, did they know it's going to work? They could have offered breakfast and been like, I'm not eating breakfast at McDonald's. Are you kidding me? That's horrible. That sickens my stomach even think about it. But no, it actually worked. In fact, some people like it so much that McDonald's had to start offering breakfast all day long, which made their franchisees really upset. Extra hours, does that actually work? I don't think so, but you open 24 hours a day, yeah, you're gonna have higher turnover, higher revenue turnover, but you're gonna have some really irritated employees. Is it worth it? So you have to do the math on that. So hiring more sales reps, changing your sales incentives, actually sales, 10% off, those kind of things can work. These are the kind of things you can do. So for your firm, you got to ask, what could this firm do to increase sales without us having to increase that denominator? How can we increase sales without adding more employees? How can we increase sales without adding more stores? The other thing Walmart is doing is advertising. So they're going to tell advertisers, we got these TVs in our store. You want to pay us $1,000 and we'll have an advertisement of your business on our TVs while people are shopping in our stores. Will that work? This could certainly work. If you actually have AI, so a customer goes by that put on Facebook, made a mistake on Facebook that they're looking for something, and that's the advertisement they see when they walk by. Who knows? Walmart's experimenting with that. There was an Economist article on it that it could be a pretty big revenue add for them. The problem is if they make it work, that's going to be a revenue decline for Google and Meta. There's so many advertising dollars. So it's not like there's going to be new advertising dollars. Walmart's going to be stealing advertising dollars from Google and Facebook, but they're going to try. They're going to see what they can do. If you were Meta at Google, we'd be a little worried about that. Yeah, probably so. That'd be a little scary. So, but that's what you're thinking about. McDonald's, someone at McDonald's, how can we add more revenue without having to add more stores? Now, McDonald's has the PlayStations. That looks like extra costs. But how many customers does that bring in? It might lose them customers. You see a PlayStation and you're a single 40-year-old, you might say, I'm not stopping there. Jason's has kid-free night. I don't go Jason's on those nights, but it might bring in other customers. Who knows? You try those things out, you see the impact, see if it works or not. Sometimes they work, sometimes they don't, but that's what you're looking for. Peloton, their big thing are the showrooms that don't sell anything, but you show up, you try out the bike, looks cool, then you go buy one, and that showroom just sits there. That's their avenue for getting customers. You might think of this in terms of, and you'll hear this a lot on Business Breakdown, is customer acquisition cost. How much does it cost you to get a new customer in? What are you expending? So Peloton, it's pretty expensive. They've got those showrooms, people come in, try out the bikes. They've got employees, they got a building sitting there, but that produces revenues later when the person goes home and orders the bike, but they don't actually sell the bike in the store. You have the same thing with floor and decor. Floor and decor doesn't really sell stuff, but you go in there, you look at the showroom, you decide what you want, and then you're going to buy it later, or your contractor does and buy it later. So those are kind of businesses are thinking, how do we get more customers? Business Breakdown does such a great job on talking about some of these founder stories and these strategies they come up with that are really, really quite amazing. All right. So for our purposes, we're going to do the easiest one, which is revenue growth. You just look at the CAGR revenue growth and assess whether it's good or not. And then the more complicated one is this capacity versus turnover. And then an easy one, which is this asset turnover. All right. So let's look at Walmart. So now I want to turn my attention to the long-term prospects for growth, starting with top line growth. Revenue growth has been, I use the word unimpressive. What else could you have used? Uninspiring, indifferent doesn't work. Mediocre, unimposing, that doesn't really work. Insignificant, average doesn't work. Insipid, don't use insipid. That's showing off. Ordinary doesn't really work. I use the word anemic sometimes. Insignificant, average, insipid, ordinary, nothing special, but you can use a thesaurus if you want to. But make sure it fits. Don't say an unimpressive 27% growth in sales. That doesn't, find a word that works. Respectable. If it's negative, find some negative word in there, make sure it fits what you're doing there. Think about the industry as well. This is retail. We're not talking about AI chips here. So, 3.26 doesn't sound strong, but it doesn't sound horrible. 3% for NVIDIA would be like the worst year ever. So, think about it in terms of the industry. I added a little extra that you could do as well. Revenue grew as much better, 4% the last 5 years. And Walmart's does seem to be a bit of a turnaround story. They seem to be taking Amazon on and doing a pretty good job of it. Taking advantage of the fact they have these stores everywhere. Amazon is going to buy Whole Foods and try to take advantage of that. They really haven't gotten that to work. They're going to try those employee-less stores where you walk in with your phone, and that I think they shut that down. They're trying these kind of things, but Walmart seems to be getting a little bit of an edge in this area, and it's certainly showing up in the last few years. All right, so that's an easy one. Second is with any retail business, assess whether growth is coming from improved turnover or increased capacity. And students mess up on this every time. If you're on your iPhone right now, you'll mess up on it too. Or if you're on social media somewhere, I can tell who's not paying attention on this one. This is a paragraph that gives it away. My graduate students just did this, and about half of them were on social media, I could tell. So what they did is they said, I looked at revenue per square foot and revenue per PP&E and blah, blah, blah. No, that's not what you do. You look at revenue per square foot and the growth in square feet. You look at revenue per PP&E and the growth in PP&E. You look at revenue per employee and what? Growth in employees, right? But at least 20% of you are going to do that in this class. It always happens. I don't know why they get confused, because if you're using Walmart as an example, it should be pretty clear. And I think the reason people get confused is because I have all those ratios sitting there. I'm not putting these ratios here for you to talk about them. I'm putting them here for you to pick the one that makes the most sense. You could talk about two of them, but if you talk about two of them, you do revenue per employee and growth in employees, and then you do revenue per PP&E and growth in PP&E. You do two analysis, all right? You don't compare the ratios to each other. So some of you are going to have NAs because you don't have any square foot. So what do? You just hide it. Don't delete. Never delete. No Control X, no delete on this spreadsheet, because you're going to mess everything else up. But hide the row. So whatever makes sense. For Walmart, they all make sense. They all have data, but I'm going to focus in on revenue per square foot. If you don't have revenue per square foot, you can do revenue per store. I prefer to do revenue per square foot because Walmart has the super Walmarts that are much larger. So it makes more sense to me to look at that. They are a little bit different. If you look at their store counts, are down, but their square feet are up. So they're building the bigger stores now. So it does give you a little bit different picture. But find one of these and focus in on that one.
The question would be, let's say, for example, in case of Walmart, where revenue on all three is positive, it'd be best to keep all three, or you just still choose whichever one.
Choose the one that's most appropriate. Now, you're going to put this chart at the end of this section. And let's say you decide to talk about this one. You can leave all of them in your paper if you want to. I mean, all in the chart, but hide the ones that say NAs. So you can have revenue per property, plant, and equipment in this chart, but you never talk about it in the paper, and that's fine. All right. But only hide it if you just don't have the data. So if you don't have stores, you don't have square foot, hide the data. You should all have revenue per employees, but if you're missing a year, like right here, you're missing a year, and it's giving you some kind of, well, here, if you get revenue per employee here, you can back into what the employees are by just taking revenue and dividing by revenue per employee. See Walmart's revenue per employee, see how low that is? Do you remember what Netflix's was? 2.6 million, Walmart's 1/10 of that. Very, very different business. Why? Because Walmart has a lot of employees. It's a retail outlet. Netflix doesn't have people checking you out. When you check out at Netflix, the computer does 100% of it. You just buy it online. So, right. So pick the one that makes the most sense for you. I did revenue per square foot. Look at Walmart's growth in revenue per square foot and growth in square feet. We can see most of the growth came from a combination of improved turnover and from general inflation. Over that time, very little of it came from them adding more square feet. Now, I find that interesting because they seem to be adding stores still in San Antonio, but they're probably shutting down in other places. They struggle in certain areas. They tried to do Walmart in Germany, it didn't really work. I think they've been fighting to put a Walmart in New York City. I love when people complain about a Walmart because they say these really contradictory things. They say, no one wants a Walmart here. If they build one here, it's going to take all the business from local businesses. They say, if no one wants it here, they're not going to take anybody's business. So what's the truth? People want it there and they're going to go shop there. They're going to put other businesses. So who doesn't want it? It's just a few people don't want it, probably those small businesses. So how would a Walmart do in New York City? It'd be pretty interesting to see. It'd be a Costco in New York City would be really, really interesting to see. So they've struggled in some places. They struggled in India. They've not struggled in Latin America. They are essentially taking Latin America over in a lot of places, even though there's some good competitors down there as well. And then you do it as a line in comparison. Here, you might leave the 90th percent or 10% in if it tells you something, but I would take it out. Here you can see Walmart is better to competition. You would expect that because they're a discount store. You expect versus other retail, they'd have more revenue per square feet just because they're stacked to the roof. Costco is probably even better because you have a very limited SKU of products, so they look good. But the other thing, so on these type of charts, you want to do two things: how do they look versus competition, and what is the trend? Here they look good versus competition, and the trend is up. So that's good. The other thing you could mention here is after being flat for several years, since COVID, they're up. I might talk about the fact that it wasn't just COVID that helped them. They continued this beyond COVID. So if it was just COVID, you just see a spike, but they continue. You see what I'm saying about Walmart? There's something going on with Walmart. Maybe the fact that their store count is so low, or their square feet, that they've actually probably shut down some inefficient stores. If I were trying to figure out which stores to close, my list would probably be revenue per square foot. I would list all of my stores, revenue per square foot, and the lowest revenue per square foot are the ones I would probably close. It'd probably be that simple because they all probably have about the same margins. So revenue per square foot is the easiest way. That's probably what Albertsons did when they shut all their San Antonio stores down. They saw that Albertsons revenue per square foot was a lot lower in San Antonio than other places, and they just shut it down. They just couldn't compete with HEB. So their revenue per square foot is particularly strong since 2019. There could be inflation in these years, right? 2022 could be inflation that's going on because we're talking about revenue here. To Carlos's point, we're not talking about cost of goods sold and gross margins. We're talking about revenue here. So the revenues went up, but the cost of goods sold probably also went up, but that's good. They have been aggressive in finding new revenue sources like curbside pickup and even home delivery. I think I told you they're not real great at home delivery, but they do home delivery. They couldn't find my door because FedEx and Walmart showed at the exact same time, and the Walmart guy couldn't find my door. I don't know what the problem was, but he came back later, and so he at least drove back and got it to me. All right, so that's the second one. This one is one students really struggling on. This is one, write it up and maybe email me that paragraph, and I can tell you if you're on track or not. We're going to get to the point where you can't just email me your paper and say, what do you think? Because I'm going to be so overwhelmed with grading. But here's the place where you could just email me a paragraph and say, am I on the right track? And I can quickly get back to you and let you know on that, all right? You can say, hey, can you give me a quick synopsis of the next 50 pages? That's going to be tough. But one paragraph, 2 paragraphs I can do. So I'm hoping most of you can handle this paragraph here. Revenue growth, was it strong or weak? I'm hoping most of y'all can handle a turnover. Very, very easy. So send me the stuff that you're struggling with and I can answer that, or show it to me after class or something. So I'm not discouraging you from coming and talking to me, but if you're pretty confident it's right, go with it. That's your confidence and just go with it. So asset turnover is very, very easy. The same thing again. How do they look versus competition, and what's the trend? Is it getting better or is it getting worse? Here, what you can see is improving the last few years and above the industry, as you'd expect for a discount store. So turnover is very strong versus the industry. Encouraging here is their ability to strengthen the statutory order what industry meeting has declined. So you can see the industry is declining. They're actually improving some. Where's Costco in here? Costco's above this 0.9 line. They're the best in the business. Right? So when you write yours, you're going to delete most of that paragraph. Don't give me Netflix. Well, you could on Netflix. Don't give me Oracle and said Amazon. Well, I guess you could say that. Give me a company, Apple or whoever. I can't think of who it is. Or Valero has a formidable competitor in Amazon. Probably not. All right. So make sure you're going to reword most of this. I'm showing you for Walmart so you can see what I'm talking about in the paragraph, but then you got to reword it for your company. Don't use the word retail industry if you're not in the retail industry. All right. There's your turnover. Comments, questions, concerns. So without looking at the notes, fill this in. Turnover, what? Oh, you already got it. Turnover, what are the 3 things you're going to talk about on turnover? Your boss says, do analysis of this firm. What are you going to do on turnover? Revenue growth. What did I talk about with Walmart for 2 paragraphs?
The asset,
Did you say turnover versus capacity? Contribution to revenue growth. Right? This is this concept of scalability. Is this business scalable? Can they grow their revenue without having to add $2 million, $3 million stores all over the place? And the last one, simple one, just look at asset turnover. And all of these are going to say 2 things. Well, on asset turnover and the capacity one, or the turnover versus employees or square feet. How did it look versus competitors, and what's the trend? Real simple stuff. This isn't some new rocket science. Pretty straightforward. Obviously, you're going to start thinking, when you look at the trend, why is the trend improving? What are they doing to improve that trend? Those are important contributions that you make to the analysis. Margins is the simplest of all. We're going to look at gross margin, look at net margin. Right? So we'll go to the class notes on that. But gross margin and net margin, very, very straightforward. I used to do one last one, but I kept it out because it was so confusing for students. So gross margin versus net margin. So let's go back to the class notes and see if we can get through some of that. Anytime, I'll say, so remember when you see turnover, you got a ratio that has something related to revenues over whatever's in the ratio. For margins, it's just a flip. If whatever's in the ratio is in the numerator divided by revenue. Margin, you always divide by revenue. That's what a margin is, something divided by revenue. The gross margin is your revenue minus cost of goods sold over your revenue. For most firms, that's a very stable number. For most firms, very, very stable. Gross margins vary dramatically industry to industry. For Walmart, it might be 25%. For Microsoft, it might be 80%. Gross margins be all over the place. The net margin is where it gets confusing because there's so many of them. So I'm picky on this, although I think I might have messed up when I did the paper. Yeah, I didn't do it. I should have done it. I believe anytime you use the word net margin, you need to say what the net margin is. Is it EBIT margin? Is it EBITDA margin? Explain what it is. Is it net income margin? I didn't do it here. I should have explained what it is. And I can't even remember. I think this is an EBIT margin. Because if you look in the spreadsheet at the bottom, no, I just said net margin, but let's look at it. C5 over C4, it's EBIT. Right, I should have said that. So make it clear. We're very confusing on this. So lot of people either use EBIT or EBITDA. That's the most popular, but you'll hear the word operating margin. I don't like operating margin. It's not well defined. A lot of times operating margin isn't EBITDA margin. Essentially, you're saying, what's the margin if you just look at the operations of the firm? So EBITDA, you might have to take something out of it that's not operating, but I prefer EBIT or EBITDA because it's very, very clear what you're doing. You know what you're doing. Net income margin works as well because it's just the net income of the firm. All right, I should put that in the chart as well. All right, so the key on net margin and gross margin is what are you measuring? So gross margin, you're essentially you're looking at the markup. This is where brand value comes in. The definition of brand value is the present value of the extra gross margin. That's brand value. That's the definition of it. So Tesla gets an extra gross margin of 10% versus Ford. You take the present value of the extra 10% margin in today's dollar, that's the brand value of Tesla. Apple can charge an extra 15% for an iPhone versus Samsung. You take the present value of the extra 15% gross margin, that's Apple's brand value. Sounds too simple. It's a simple concept. It's a really hard thing to calculate, but it's a simple concept. So gross margin is really a measure of your brand value. Higher gross margins means you have higher brand value. It also talks about your pricing power. So we saw inflation in 2022 for firms like General Mills and Procter & Gamble. They were asking the question, how much of that inflation can they pass on to their customers by raising their price? So there's a very big focus in 2022 on gross margins. We know the revenues are coming up because of inflation, but are your cost of goods sold going up more or less? That's your pricing power. How much of that can you pass back? What's the word we use in economics? The price. So say it again. No, well, I can't hear you, but did you say elasticity? Yeah. Elasticity? Yeah, price elasticity. What does that all mean? Price elasticity, increase price 2%, volume falls 1%. That's good. That's price inelastic. Increase your price 2%, your volumes fall 4%. That's price elasticity. Your customers are very sensitive to the price, right? So all of this in gross margins has to do with that brand value, has to do with price elasticity. But for most firms, it's pretty stable. It doesn't fluctuate around. Wait, I'll be curious if any of your firms have a really fluctuating gross margin. Even Valero, yeah, oil prices are going up and down. That's their cost of goods sold. But we as consumers, we're pretty used to seeing oil prices rising and gasoline prices rising. And we just buy the gas anyway. We don't really have much choice. You don't go protest Valero, you go protest Exxon. You know, it's the gas prices are up because oil prices are up. Net margin's a little bit more involved. For net margin, it's first of all, it's the flow through of the gross margin. So if you have a higher gross margin, that's probably going to give you a higher net margin. So all that flows through. But the next thing that flows through is this real important concept. It's operating leverage. Now, you know the word leverage, but you usually think of leverage in terms of financial leverage, which relates to how much debt you have. Operating leverage is similar, but different. So financial leverage, what does leverage do? It makes good stuff look really good. It makes bad stuff look really bad. Why? Because financial leverage, you got to pay your debt holders no matter what. So having a good year, you pay them a fixed amount. And so you get to keep, you know, your revenues are up, your income's up. You pay your bondholders the same amount, your net income is going to grow. And a bad year, what happens? Your net income falls. What do your bondholders say? Oh, you know what? You're in a bad year. You know, just pay us next year. Is that what they say? No. You got to keep paying them. That's a fixed cost. Operating leverage is all your other fixed costs except for debt. So how much fixed cost is in your cost structure? That's operating leverage. Some of you had me before know how I calculate operating leverage. So I'll look at the volatility, the standard deviation of net margin. My philosophy is firms with high standard deviation net margin must have high fixed costs. Because the more fixed costs you have, the more volatile that net income is going to be. All right, so that's operating leverage. How do you manage this? Some of it's just your expense management. Is the firm being efficient or defining ways you'd like to use robotics or whatever to do things? I don't know if HEB and Walmart are doing inventories with robotics, but they probably are. I haven't seen too many robotics around. It goes back to that margins, but then the last thing, here's what we'll start with next class, is the operating leverage and how we're going to handle that. You want to think about that with your firm in realistic ways. So NVIDIA's revenues go up. Are their employees fixed costs or variable costs? So you have to kind of think about that. If their revenues go up 20%, are they going to have to add 20% more workers? Is that a variable cost? Or can they keep doing the same thing? So we saw with Netflix, their revenues go up 22%. How many employees did they add? 22%. All right. Employees are fixed costs. At McDonald's, maybe not. They're hourly employees. So we're going to talk about that. You got to try to figure out the cost structure of your firm. All right. So we'll start there. All right. I'll end it there.